What if the greatest threat to your real estate wealth isn't market crashes or bad tenants, but a wave of aggressive tax policies quietly being drafted in state capitals and Washington? Across America, property owners are facing an unprecedented fiscal squeeze. Soaring assessments, elimination of key deductions, new wealth taxes targeting real assets, and proposals to tax unrealized gains. This isn't speculation, it's already happening. And if you're not prepared, your hard-earned equity could vanish, not through depreciation, but through legislation. For decades, real estate investors enjoyed structural advantages: mortgage interest deductions, 1031 exchanges, depreciation write-offs, and favorable capital gains treatment. These weren't loopholes, they were intentional incentives to encourage housing supply, entrepreneurship, and long-term ownership. But as federal and state budgets strain under debt, aging populations, and rising social spending, policymakers are turning their gaze toward the largest store of private wealth in America: real property. Residential and commercial real estate combined represent over $40 trillion in U.S. household net worth, making it the single biggest target for revenue-hungry governments. The first front is property tax reassessment acceleration. Traditionally, many states limited annual assessment increases, creating stability for long-term owners. But now, cities like Chicago, Seattle, and Austin are pushing circuit breaker overrides or full market value reassessments to capture windfall gains from recent booms. In some jurisdictions, property tax bills have doubled in 2 years, not because values rose that fast, but because legacy caps were removed. If you bought a home in 2010 for $200K and it's now worth $600K, you may suddenly be taxed as if you've been cashing out equity all along. Second, the mortgage interest deduction, MID, is under siege. Once available on up to $1 million in debt, it was slashed to $750K in 2017, and now lawmakers propose eliminating it entirely for second homes or investment properties. Without MID, the cost of leveraged real estate rises significantly. For landlords using mortgages to scale portfolios, this erodes cash flow and forces rent hikes that could trigger tenant backlash or vacancy spikes. Third, the 1031 like-kind exchange, the backbone of real estate wealth compounding, is in existential danger. Multiple administrations have floated plans to cap or eliminate it, arguing it primarily benefits the wealthy. If repealed, every sale of an investment property would trigger immediate capital gains tax, often 37% plus state levies. That destroys the ability to reinvest full proceeds, effectively freezing portfolio growth and locking owners into underperforming properties just to avoid tax bombs. Fourth, depreciation recapture rules are tightening. The IRS already claws back depreciation deductions at a 25% rate upon sale. New proposals would accelerate this or apply it annually, treating paper losses as taxable income, a devastating blow to deals that rely on tax efficiency. Fifth, state-level wealth taxes are gaining traction. While the federal wealth tax remains stalled, states like California, New York, and Illinois have introduced bills to tax net worth. These bills target net worth above thresholds as low as $1 million, including primary residences and rental equity. These hit even if you're not selling. Unlike income taxes, these hit even if you're not selling or earning passive income. Just owning appreciating property could trigger annual six-figure bills. Sixth, the most radical threat, taxing unrealized capital gains. This would treat asset appreciation as taxable income each year, even if you never sell. A home rising $100K in value could generate a $20K plus tax liability with no cash to pay it. Forced sales, fire sales, and market distortions would follow. These aren't fringe ideas. They're in active legislative committees, backed by data showing real estate owners hold disproportionate wealth. And they're amplified by political narratives painting landlords as greedy amid housing shortages, ignoring that small investors provide 80% of U.S. rental housing. But here's the critical insight. This tax shift isn't random. It's predictable. Governments always target immobile, visible, and politically unpopular assets first. Real estate checks all three boxes. Unlike stocks or crypto, you can't move your apartment building offshore. Unlike wages, property wealth is publicly recorded. And in times of inequality angst, landlords make convenient villains for revenue-hungry governments. It's a calculated political and fiscal shift. Yet within this storm lies opportunity for those who act early. Because while policy changes are inevitable, their impact isn't uniform. Savvy owners can restructure, relocate, or reposition assets before laws take effect. The window is narrow but open, and the strategies aren't about evasion. The strategies are about alignment with emerging rules. It's about understanding the new landscape before it becomes law. How do you shield decades of equity building from a system increasingly designed to extract it? The answer isn't panic, it's precision. It requires understanding not just today's code, but tomorrow's trajectory. And it demands action that goes beyond standard CPA advice. Because traditional tax planning assumes stability. What we face is disruption. You need a strategy built for a volatile world. In Part 2, we'll move from diagnosis to defense, revealing 7 concrete legal strategies to protect your real estate wealth, preserve cash flow, and even turn tax pressure into advantage. These aren't theoretical. They're being deployed right now by forward-thinking investors who refuse to let policy undo their life's work. The goal isn't to hide wealth, it's to future-proof it. Secure your legacy today for a stronger tomorrow.
Now that you see the threats, accelerated reassessments, eroding deductions, 1031 repeal risks, wealth taxes, and unrealized gain proposals, it's time to build your defense. The good news? You don't need offshore shell companies or risky loopholes. The most powerful protections are legal, transparent, and rooted in smart structuring. Here are 7 actionable strategies to safeguard your real estate wealth in the coming tax era. First, optimize entity structure proactively. Holding properties in LLCs isn't just about liability, it's about tax flexibility. An LLC taxed as an S-corp can convert rental income into salary plus distributions, potentially reducing self-employment tax. More importantly, multi-member LLCs or family partnerships can distribute ownership to lower bracket relatives, spreading income and avoiding top marginal rates. Crucially, do this before values surge or laws change. Transfers after a tax hike may trigger reassessment or gift taxes. Second, geographic arbitrage is your ally. Not all states are equal. Florida, Texas, Tennessee, and Nevada have no state income tax and relatively stable property tax regimes. Even within high-tax states, rural counties often offer lower rates than urban cores. Consider selling overexposed assets in California or New York and redeploying into landlord-friendly markets like Indiana, Alabama, or the Carolinas. Yes, you'll pay capital gains, but if future tax savings exceed that cost over 5 to 10 years, it's a win. Use a 1031 exchange while it still exists to defer that hit. Third, maximize cost segregation studies. This underused tool accelerates depreciation by reclassifying building components like carpet, lighting, and plumbing as 5, 7, or 15-year property. The result? Larger upfront deductions that offset ordinary income at higher rates. Front-loading these benefits locks in savings before rules tighten. Fourth, shift from appreciation plays to cash flow focus. In a world where unrealized gains may be taxed, equity buildup becomes a liability. Instead, prioritize assets with strong current yields, triple net leases, mobile home parks, or workforce housing in growing Sunbelt cities. Cash flow funds tax payments. Paper gains don't. Bonus: high-yield assets often attract fewer speculative buyers, keeping entry prices rational. Fifth, leverage opportunity zones strategically, but cautiously. While the program's future is uncertain, existing investments still enjoy 10-year deferral and basis step-ups. If you have gains to shelter, pairing them with OZ projects in emerging districts can yield both tax benefits and community impact. Just verify project sponsors thoroughly. Many early OZ funds underperformed. Sixth, build a tax moat with irrevocable trusts. For portfolios exceeding $1 in equity, consider transferring assets into a domestic asset protection trust, DAPT, in states like Delaware or South Dakota. These shield property from creditors and can freeze valuation for estate tax purposes. While complex, they're invaluable for intergenerational wealth transfer, especially if federal estate exemptions drop from $13 million to $5 million as scheduled in 2026. Seventh, and most overlooked, become a policy-aware investor. Track local ballot measures on reassessment caps. Join landlord associations fighting wealth tax proposals. Support candidates who understand small-scale real estate's role in housing supply. Your voice matters more than you think. In 2024, grassroots pushback killed wealth tax bills in 3 states. Collective action works. Now, what if 1031 exchanges vanish tomorrow? Have a plan B. Deferred sales trusts, DSTs. These allow you to sell a property, place proceeds in a trust, and receive payments over time, spreading capital gains across multiple years. It's not as clean as a 1031, but it avoids a massive one-time tax hit. Similarly, installment sales let you carry the note yourself, recognizing gain only as payments arrive. Don't forget charitable remainder trusts, CRTs, for highly appreciated assets. Donate property to a CRT, get an immediate deduction, receive income for life, and pass remaining value to heirs tax-free. Ideal for older investors looking to simplify and give back. Finally, audit your portfolio annually with a tax-forward lens. Ask, which properties are in highest reassessment risk zones? Could any be converted to primary residence, gaining $250K, $500K exclusion? Are expenses fully optimized? Repairs versus improvements, mileage logs, home office. This isn't paranoia, it's prudence. The investors who thrive in the next decade won't be those with the most units, but those with the most resilient structures. Remember, taxes are the price of civilization, but they shouldn't consume your life's work. By acting now, you turn vulnerability into strength. You honor the effort it took to build your portfolio by ensuring it endures. If this urgent roadmap helped you see the hidden risks and opportunities ahead, please like, share, and subscribe to 100x Wealth. Hit the bell icon so you never miss our latest videos on AI, Web3, and intelligent strategies to protect and grow your wealth in an era of unprecedented change. Because in the coming tax landscape, foresight isn't optional, it's your ultimate asset.